Hi, Jeremy Peterson here with Vesta Real Estate in Ogden, Utah. It is time for another real estate market update. Let's go ahead and talk about the headline numbers first before we dig into the really nitty-gritty stuff. First, let's talk about our year-over-year price changes. From October to last October, prices are still up 4.3% for now. Prices from September to October are down 6.2%, and we'll take a look at that in the chart and see how that looks. Since June, prices have dropped 8.1%. Days on market is currently 39, and sales volume is down 40% from this time last year. First, before I get started, you might notice that my beard is gone. For the last 2.5 years, I've had a beard, and now I look like... if this is your first time watching, hello. If you've been watching for years, I'm sorry. So what's happening in the market right now? Let's talk about days on market. This chart probably looks the most normal of all the charts that I'm going to show you today. You can see that we are up to about 39 days. Typically these charts peak out in the winter time in January or February, and so we still have a few months to go before this will top out. And so we expect days on market to increase at least through the winter months. So let's talk about house prices and what's happening there. When we look at this chart, we can see that we have come to the end of an incredible 10.5-year run-up in real estate values. The last time this happened was in 2007, when many of the young agents in the real estate market were in elementary school. Let's talk about price growth. This chart shows our annual growth of house prices year over year. You can see we topped out at nearly 32%. And now we've entered a trajectory downward, which soon appears to be turning negative. One of the questions I get asked is this going to be like the Great Recession in 2007, 8, 9? And while history does not necessarily repeat perfectly, it does rhyme on occasion. Last time we had really bad underwriting standards for loans. It was a credit boom, and more homes were built than there were people to live in them. It was very easy for homeowners or investors to walk away from properties that were never going to be occupied because there simply weren't enough people to live in them. Today, it's really an affordability problem. We have stratospheric interest rates, and nobody can afford mortgages at the current interest rates. If we look at our interest rate chart here, you can see that interest rates over the last 30, 40 years have been on a downtrend, and then suddenly they've increased at a record rate. It took us 20 years to get from 7% to 3%, and it took us 12 months to get from 3% back up to 7%. That's unprecedented, it's historic, and that is really the main source of our woes right now. Regarding affordability, let's look at our inflation-adjusted mortgage payments chart. It's kind of an index to show us relative values of mortgage payments, whether things are cheap or expensive. And as you can see here, the chart has just gone haywire over the last year. The last part of the chart doesn't seem to make any sense relative, to the last 30 years that it's been tracking. A quick look at sales volume shows that our sales volume is down 40% year over year. We had a bad month several months ago, and then things got a little better, and we've had another bad month in October. That does not bode well for all the realtors out there who survive off transactions. These are starvation transaction levels, and I'm sure there are some agents out there that are getting a little hungry. So let's talk about a couple big questions that get asked. One is, how long will this last? And the second is, how low will prices go? Now, predicting the future is difficult, but we can take some guesses based on data, and so that's what I'm going to talk about here for a minute. If the market follows any kind of symmetrical pattern, and if we look back in the record, house prices do kind of follow a pattern, especially during the Great Recession. We saw a very symmetrical cone in that. We could take a couple stabs at what we think house prices might do moving forward. So if we were to return back to our pre-COVID growth trend, and you can see that here in this chart, the yellow line would be the trend, it might take us a couple years to get back to our regular growth trend. And prices would obviously walk down to that trend line and then resume That might take a couple years. Another tool that we have to kind of tease out where prices want to be right now relative to where they are is a tool that I've used called a break-even price analysis. We use this for investment properties, and it answers the question of what price would an investor pay right now in today's interest rate environment to break even on an income property, meaning they wouldn't make any money, but they wouldn't lose any money. But based on interest rates today, what would be the sale price that needs to happen for that property to break even? You can see here in this table that I've created that when interest rates were 3% back in January, an investor, let's take a look at the $3,000 rent level there. The investor would be willing in January, when rates were 3%, they could pay almost $600,000 for that property and they would break even. So fast forward to today, where rates, last week were 7.08%, and that same investor would have to pay $400,000. They could only pay $400,000 to break even on that same property with the same rents. That's a 33% difference between those two numbers. And that is the tension that is existing in the market right now. It's invisible, but you can feel it. And that is what is pulling prices down right now. And the market wants to reach an equilibrium point where buyers and sellers can transact and buyers are not totally hamstrung by these mortgage payments. If prices drop, that eases that tension and allows things to happen. So the market has already given up 8% of its value since our peak in June. So if a 33% is the drawdown that needs to happen, and this is assuming that rates stay where they're at, then we've got another 25% to go before we reach that equilibrium. And that process might take several years to play out. So there are several factors that contribute to how long this process will last. Obviously, there's interest rates, which are subject to a whole host of other variables. What might bring interest rates down? Well, if we had a war, that would bring interest rates down. The government would need cheap money to spend on bullets, boats, and bombs. Another thing that might happen would be a major recession. And a recession would cause rates to go down and things would become more affordable at that point, at least for those of us that still had jobs. So that's not a great scenario either way, but that is what would help bring rates down. Obviously, if the Federal Reserve Bank decided to start buying mortgage-backed securities again, that would do so, but given the current climate, it doesn't appear that is going to happen. Also, if the market's going to correct and all other things remain equal, prices are going to be the factor that adjusts downward, and we already talked about how long that might take. Another factor that would improve the current situation would be a productivity increase among workers. If technological innovation helps make workers more efficient and effective, their wages would effectively rise, and all other things remaining equal, that would make homes and mortgage payments more affordable. So if workers are earning more and the costs are staying flat, that makes things more affordable, and that's good. So productivity would be a great way to make things better. Unfortunately, with productivity, it takes a lot of resource investment and time. Obviously, interest rates are going to fluctuate based on world events and central bank activity, and prices are kind of sticky and they take a while to walk down to an equilibrium point. They don't move instantaneously. So the bottom line with this is that it's going to take us a while. I estimate it might be between 1 to 4 years before we work ourselves out of this new trend. So what do buyers and sellers do in this current market? For sellers, they need to be mindful of how their house is positioned price-wise on the market. They can't expect to just put a price out there and let the house stay if they're not getting any activity. They're going to need to be nimble and stay up with the market trend in the direction that it's going. And if that means adjusting prices periodically, that will need to happen in order to stay competitive in the marketplace. Now, there are some alternatives. For instance, if a seller wants to consider seller financing or a lease option, or in a worst case scenario, renting out their home, they can protect their equity over time and then come back to that at a later point to bridge the valley in the market. If you need an agent that knows how to do those things, I've got a lot of experience in all those transactions. So just give me a call. I can get you more details. We'll do a separate video on all these later. For buyers, buyers can expect that sellers will offer them some kinds of concessions, whether it's seller closing costs, or they might be able to buy down their interest rate on their mortgage. Now, you're not going to see someone buy their mortgage rate down to 3% again. That is just not possible in this market right now. But you might see a half or maybe 3/4 of a point difference if a seller is willing to offer some concessions to buy down that mortgage rate. That will make a home more affordable, and often for a seller, it's worth their while to do that more so than reduce the price. So that's something to explore for both buyers and sellers. If you're a buyer and want to know more about how that works, give me a call and I'll let you know. The market is very dynamic and things are just starting to get really interesting. So if you need help with buying, selling, or leasing your property, give me a call and I'll help walk you through it. Thanks for tuning in.